Hi, I'm Steve Van Metre and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night to answer your questions and try to make sense of markets that don't really make any sense at all. Now, a quick little housekeeping issue because I am really excited about tonight's video. I'm calling it Investors versus the Fed. Now, why am I excited? It has nothing to do with what happened in the markets today. I've got some really great questions in that I'm going to try to back up with as many charts and graphs as I can. I've got some great content to share with you. I want to talk about gold. I want to talk about the dollar. But first, I'm going to be publishing a video on how to enroll and how Social Security benefits work, hopefully in the next couple of days. And this is going to be the beginning of me putting out short videos. So this one's going to be 12 minutes long on a very specific topic. Now, for those of you who are wondering why Social Security, well, I teach a class at my local junior college on retirement planning, so I have a lot of content geared for people who are headed into and are near retirement. So since I have it, I'm going to start using that first, and then I'm going to go back to some of the other questions that you've asked me, like what a great question was, how does the Fisher equation or the Fisher formula work in terms of interest rates and bond yields? Great question. I thought I'm going to do some short videos like that. So when you see this come up, if you're not anywhere near Social Security age, don't worry about it. But if you are, it's a really great video. And if you're not, is there someone you know, maybe a family member, a parent that's getting near that age, or maybe has unfortunately lost their job recently and maybe facing a earlier than expected retirement? This video will help them a lot. So again, as I said, today's video, investors versus the Fed. Now, on Monday, I kind of made a comment that I really didn't understand why the markets were going up, and I was actually somewhat joking about that. And a few of you sent me some ideas of, hey, maybe it's this or that, and I really appreciate that. I do. I was kind of joking because the market is weirdly bullish right now. And I really don't get it. It's not that I don't understand why people are bullish. I actually do understand why people are bullish. I just don't understand how they can be bullish. So far 10 million Americans have lost their jobs. Tomorrow we're going to find out how many more millions have lost their jobs. And the next week there's going to be even more millions. Some of you have lost their jobs. I have friends, family members, people in my industry have lost their jobs. And yet, for some reason, there's this whole part of the economy of investors that are just worried about, is the bottom in? And it's like, how can the bottom be in when 10 plus million people are on the unemployment line? I don't understand how that can be the focus. Because my heart goes out to you. If you've lost your job or you're facing that reality in the weeks to come, maybe you've got a business and you're wondering what's going on and how you're going to be in business much longer. Look, I understand. And it troubles me that people can be so bullish about stocks when some people are worried about how they're going to feed their families tomorrow, how they're going to pay their rent, what they're going to do. And it troubles me. Because markets do not bottom when 10 plus million Americans are on the unemployment line. And yet everyone thinks, oh, this is inflationary. How is people making less money, whether it's from an unemployment benefit or through a government transfer, through the stimulus bill? How on earth can that be inflationary? But yet, it's weird. We just have this two sides of the economy. Worried about the market bottoming, gotta get in. Worried about what I'm going to do tomorrow to take care of my family and hope nothing else goes wrong. That's where I'm struggling. Because millions of Americans on the unemployment line is not bullish for the market. So why are people bullish? Well, bear markets come in three flavors: 25% down, 33% down, or 50% down. Now, if you get over 50%, which has happened in the past and probably will happen in the future, you call that for the record books. But what happened was many investors were heavy in stocks with no thought that the market would ever go down, that we're at the beginning of a 20-year bull market like it's in the early 80s. This is what they believed. They didn't see the market drop coming. And like a gambler who took a big loss, rather than come to the conclusion that, hey, we're in the middle of the largest modern day pandemic, which is closing down businesses, putting people on the unemployment line. Somehow that's got to be bullish for stocks. I've got to get back in. I've got to double down because the bottom's got to be in. We were down, 33%. That's right in the middle. That's it. The 3-week bear market, fastest in history. Now back onto the bull market. I've got to take more leverage, more risk, sell more of the underperforming stuff, buy more of the risky stuff. I got to get my money back. I don't get it. But that's the view right now. Is somehow the suffering of 10 plus million Americans and growing is great for stocks. And it's not. And it won't be. But what's happening is the people that are on that side of the fence that are bullish stocks, they've taken a hit too. They just couldn't afford it. And now they think it's going to come back to them. That somehow the Fed is going to orchestrate some monetary magic. They're going to wave their magic wand and QE this thing until it goes up, and they can't miss out. Even though there's no evidence anywhere in the history of central banking that it will work. But yet people believe. And they're willing to bet their life savings on it that already has gone down, that it's going to go back up again. Now, I don't believe that that's what's going to happen. For years, I've said that this market is going to look just like it did in the 1930s. It's going to follow the Great Depression. Now, why do I say that? Because a Russian economist, who I cannot properly pronounce his name, who was killed for his view, came up with the idea that there are these long wave economic cycles, much longer than the 8-year cycles and 10-year cycles that we're used to. These run like 80 plus years with a plus or minus 10-year tolerance on each side. And what he figured out was, in a debt-based economy, you start out with debt. And then that debt becomes a little bit rotten, so you pile more debt on top of it. And like a compost bin of debt, this old debt starts to decompose, and it's nasty and smelly, and we'll put more debt. Hey, if we just get some better debt, the problem is that debt was bad. Let's get some better debt and stack it on top. So we keep stacking more and more debt, and that old debt keeps rotting and rotting and rotting and rotting and rotting away. And eventually, the whole thing comes crumbling down. And if you go back to 1930, and you add 80 years, you get 2010, the great financial crisis. And somehow, by some miracle, the Federal Reserve came to the rescue and kept the whole system running a little bit longer. They almost didn't. The great financial crisis about destroyed the global financial system. But no, with a little bit of QE, a whole lot of QE, and other acronyms that the Fed comes up with, we can make this work. We are the monetary wizards. And people believe. But what's happening now is the system starting to fail again. The coronavirus is just the accelerant. And what's going on is the global economy is like your car stuck in the mud and you're spinning your wheels. There is a point where lower interest rates don't work, where more QE, more Fed magic does not work. And so what happened in 1930, and I believe I'm one of very few people who believe this is how it's going to play out, is the market went down a whole bunch. And then everyone started to believe in the Fed, and there was a 50% increase. Now, I don't think we've gotten to that point. So this increase recently, I don't think this is it. I think there's a whole nother leg down that's validated by the Treasury market. We'll get to that shortly. But there was a 50% increase, and everyone thought this was it. This was the bottom. They loaded in, and then there was a next plunge that took the market down. I think that is what's going to happen. So I think we're going to go down more, have a big rally that everyone's going to be excited about, and then the boom. And then it's going to come out that, no, the global economy is in bad shape and more QE, lower interest rates, none of it's going to work. And then you're going to get that last move down, however long it will take. That, I think, is what is to come. But everybody's bullish. And it's really simple. If you look at the markets, if you're bullish on stocks, yes, I got the arrows out. We're in full force today. I got arrows, chart, you name it, I've got all my toys out. So if you're bullish on stocks, you have to be bearish on treasury bonds. That's how our monetary system works. And if you followed my channel for a while, you know how this relationship works. You might not fully understand it, but keep watching. It'll work. Trust me, it'll all come to play. And I will keep sharing it with you until it makes sense. So if you're bullish stocks, you have to be bearish bonds. Now, why is that? You want yields to go up. And how do you do that? Well, you could just not own bonds. Or you could short bonds. Now, you remember back to Monday's video, we looked at how hedge fund managers are positioned. And they backed off their shorts in 10 years, but they increased their shorts on 30-year bonds. They are forced to short. So what's happening now is the bulls are trying to drive stock prices up, but the problem is yields are going flat. They're just not getting, they need yields to go up, but they're not getting any traction on it. Why? Because the Federal Reserve is buying $1.8 trillion worth of Treasury securities and mortgage-backed securities per month. The Fed is trying to push rates down, and the market's trying to push stocks up. There is a point where stocks will stop going up unless yields start to rise. And we're getting really close to that. You have to think of this kind of like a sporting match. Maybe it's a boxing match. You have the Fed on one side, investors on the other. Who's going to win? I'm going to put my money on the side that can buy $1.8 trillion worth of Treasury securities and mortgage-backed securities per month, every month for as long as they want, or more. Investors will eventually run out of money. But yet everyone's betting the stocks go up when they don't understand that relationship. And so let's take a look. Here are 10-year Treasury yields, and let's overlay the S&P 500. And let's see what happened today. And what you'll see is, as yields went down, it put downward pressure on stock prices. Yields went up, stock prices went up. Yields went down, it flattened out stock prices. And then yields went up and stock prices went up. Let's go and zoom out over 90 days. And you can sort of see, I know it doesn't really line because of the gaps in overnight trading. You can see there is a gap forming between stock prices and treasury yields. Let's go out 6 months where it's a little cleaner to see. Now you can see that gap forming again. There's a bigger gap, but this is a small gap inside the bigger gap. And in order to validate stock prices continue to go up, treasury yields must rise. There's no way around it. They've got to go up. If they don't, then the stock market will eventually go down. Now, why is that? It's because all those people who are short the bond market are going to be forced to sell stocks to buy back into bonds. That's how it works. So we know that. So that's why the market's doing what it's doing. The natural direction is if the public or investors are bullish, the market will try to validate them. The Fed, on the other hand, is saying, no, you can pick your side. I've got mine already picked. Let's get into your questions. And I had them pulled up in the first run of the video, but the power went out and apparently my recording program does not save on the fly. All right, thanks again for your answers. You're very welcome. I've noticed today a lot of the top performers are financial institutions and mortgage companies. Does this have to do with free Fed money? No, it does not. Or is this more retail investor delusion of a recovery? Well, yes, partially. Is the Fed buying these guys up through the mortgage-backed securities? No, they're not. So one thing that you might not know is that financial companies and treasury yields tend to trade inversely. Tend to. Not always, but tend to. So let's pull up XLF, which is a large, and if I meant inversely, I meant they trade together. Treasury yields and financial stocks trade together. Not exactly, but they follow the same path. So what that means is if you believe interest rates are going up, then you want to buy financial stocks. Now, it doesn't always work. It's not always perfect, but the general direction is that is the case. And you can go back and see here in the financial crisis that yields went up, bank stocks went up, and you can see there's a nice relationship there that eventually did break down, and that gap is trying to close. We can see that here between the two. So that's why you see financial stocks going up, because it's trying to say that interest rates need to go up. Everything is trying to say, look, stocks got to go up, oil's got to go up, financial stocks got to go up, and as a result, interest rates have to go up. But the problem is the Fed's mopping up everybody who's selling bonds. Everybody. And at some point, the Fed's going to win. Great question. Let's go on to the next. In addition to gold this week, can you cover oil? Yes, we'll look at oil. And oil's a tough one, but we'll take a look at it. And ticker DBA, since we're wondering where inflation is going. Yeah, look, so for those of you who don't know what DBA is, it's an agricultural commodity fund. And it is at its pretty much its all-time lows. So usually what you see is during recessions, you see this big surge in crop prices. It's not exactly that clear, because what really happens is crop prices follow the solar cycles. Now, if you're not familiar with the solar cycles, let's go here to the NASA website, the Space Weather Prediction Center, and here are the solar cycles going back to the 1700s. And this is now this data isn't the oldest data. This is the oldest cycle data on the planet. Man was tracking sunspots before anything else, because they realized that the sun could affect their crops and they needed to know. So what happens is during solar minimums, the sun emits fewer sunspots. So we can go look, and here's not exactly live, but it's a picture from today of the sun, and you'll notice there's no black dots on it. So there are no sunspots. And what does that mean is when the sun emits a spot, it is hotter than normal and puts out more solar rays and all that good stuff that hit the planet. So when the sun is cooler than normal, even though it's really hot, it affects the weather and crops. So if you notice the weather has been weird the last year or so, that's because of the solar cycle. If you've noticed we've had biblical style flooding because of solar cycles. If you notice we've had biblical locust plagues going on, solar cycles. And here they are. So we are at the bottom of a solar cycle, which means crop prices should be going up. And here you can see kind of a zoomed in version. Crop prices usually go up here. They're usually skyrocketing by now. Unfortunately, everybody is short this that can be short these things. For whatever reason, that's what's going on in the market. Everybody's short. So if you're looking for inflation here, you won't find it. It is also worth noting the worst recessions we have are at the bottom of these cycles, because this is when humans are least productive. We're more productive when there's warmer weather, least productive when there's cooler or inclement weather. And that was one of the reasons the great financial crisis was so bad. And one of the reasons I've said this next recession will be bad as well. All right, crude oil. Now, crude oil is tough to look at because it's the most manipulated commodity on the planet. And you can see it's way down here, 25 a barrel. There's an OPEC meeting tomorrow that everyone's hoping for a 10 million barrel per day cut in production. I'm not holding my breath on that. And even if it is, it probably still is enough. I still think oil goes down from here once people realize how bad the economy is. From an inflation standpoint, at 25 a barrel, non-existent. You do not get inflation at $25 per barrel oil. We'll get back to gold in a little bit later. I'm not going to forget about it. To prove my point, I even have the gold playbook out. I said I brought everything out. I still don't remember when I made this. I don't remember why I made it. I do remember that I needed to make it, and I lost it, and I found it, and we're going to put it into chart form today and try to see if I'm right or wrong about what I think is going on with gold. Okay, here's a question for you next time. Do you believe the market will bottom sometime in the next 90 days? Okay, here's what I believe. I believe that interest rates, treasury yields will go way down in the next 90 days. Stocks will follow that. Do I think that is the ultimate bottom? No. Will it be a bottom that everyone thinks is a bottom? Yes. But as I mentioned earlier, I think it follows 1930 where there's a big rebound. People will buy into it. They will chase it. Those that are skeptical will buy in late, and then they'll find out that the economy is really weaker than everyone thought and that the Fed's magic doesn't work, and then you'll get that last move down. I know you said we have not hit bottom yet, and I also know that you have said that you believe the bond market will pick up sometime within the 90 days. Same thing. So yields go down, bond prices go up, and the peak rally will be short-lived. Yeah, that is absolutely true. And the reason why is, unlike bull markets in stocks that go on for years, bull markets in bonds are a matter of weeks. They're very, very short-lived. So this is a weekly chart of TLT. And we can go back to 2008. You see this big spike right here? 6 to 8 weeks. You get just massive amount of people forced to buy bonds. It shoots straight up. You hope to sell somewhere up in this range. And then it goes down. And then you look to add back to your portfolio because there's a second wave coming. That's kind of how you want to play the bond market. A lot of people don't know that you can make an equity-like return in the bond market faster than you can make it in the equity market. I've heard Dr. Lacey Hunt. If you don't know who this guy is, in my opinion, he is probably the foremost expert on the bond market alive today. And I've tried to take as many concepts of his that I can understand. The guy he is super smart. So anytime he speaks somewhere or publishes something, I try to read it and I'll try to put it in the language that we can all understand. One say that you can calculate the expected inflation rate. I don't know how he does that. I'll just be open with you. I've seen some sites refer to it as a projected inflation rate. Can you show us how it's done? No, I can't, as the current inflation data seems lagged. It always is lagged, but I will show you the next best thing of how Steve looks at inflation. And let's go to the Federal Reserve website. So here I've got 3-month Treasury bills next to the year-over-year rate of change of the Consumer Price Index. And what do you know? There is a nice, beautiful relationship. So when the Fed raises rates, prices go up. Now, I don't subscribe to inflation being consumer prices, but we have to work with what the Fed thinks it is. And you can see on this chart that generally when interest rates rise, consumer prices rise. And when interest rates fall, consumer prices fall. Now, you're going to say, well, wait a minute, what about 2008? Yeah, okay, let's zoom in. So what happened here? Consumer prices rose into this recession. So wait a minute, that kind of doesn't go with what you think. All right, well, let's expand upon this. Let's try to figure out why that happened. And then answer the question is, will it happen again? So we're going to add crude oil to this chart. We'll make it black for crude oil. And we have to go, black, and change it to, because I think it's running a year-over-year basis. Let's go back to dollars per barrel. And voila. So what happened, and we'll zoom in a little bit. You can see crude oil prices rose into the great financial crisis, and it drove consumer prices up. Those two were holding hands, lockstep, all the way up. Then crude prices collapsed, consumer prices collapsed. Now, let's look. 3-month Treasury yields are down. Crude oil prices are down. Where do you think inflation is headed? Yeah, it's headed down. We just haven't gotten that print yet because the consumer price index is lagged somewhere around 6 months. It's pretty lagged. It uses some old data. So it will fall. At least that's kind of my belief and why I'm very bullish on bonds. So I don't know how Dr. Lacey Hunt does it. If I ever figure it out, I'll share it with you. But I don't know. That's how I look at it. In your opinion, how will 50-year bonds affect TLT's price? TLT being a 20-plus year Treasury yield bond, I don't think it affects it significantly. Now, because it is a 20-plus year, if 50-year bonds do come to existence, which I don't think they will, but if they do, then I assume the TLT would buy them. The only thing it would change is what's called the duration, and duration is the maturity of the portfolio if it started buying it, which I assume it would. All that to say is, if interest rates go down, it means TLT would go up more, and if interest rates go up, TLT would go down more. But I'm not convinced we're going to have 50-year bonds. We might, but I'm not convinced. Okay. Been watching your YouTube videos from last year. Great. And I wanted to thank you for teaching me amazing amounts. I'm really glad that you took the time to watch them and that you're learning. That's what we're here for. I have a question I hope you can answer for me. I will give it my best. You mentioned on a couple of videos that you think gold will drop. Yes, I do. But you also think bonds have to go higher to go. Correct. I was wondering if you've checked the correlation between bonds and gold and what your thoughts are. Aha, great question. Because here's somebody who's probably actually looked at the chart and saying, I don't agree with you, Steve. And that's great. I don't ask you to. This channel isn't about agree with Steve. This is about sharing my opinions, my view of the markets. And so here are bond prices, TLT, overlaid with GLD, which is a gold ETF. And we'll zoom out. Oh, we are zoomed out. Are we on the weekly chart? No, we're on the daily chart. Weekly chart. There you go. So you can see that generally when bond prices are trending higher, gold is trending higher, bond prices higher, gold higher, bonds down, gold down. So you say, okay, what gives? Then why is it this time you think it's different? If we zoom into the daily chart, you can see this really nice relationship here. And you would have to argue that I am wrong about my opinion. And that's a fair assumption. With the exception of right here in 2008, we saw this big shoot higher in bonds. And the general trend, if you look at gold, so gold peaked and went down with bond prices, and all of a sudden bond prices took off and gold went down. I think this happens again. I think we see this happen one last time. And I think it's due to the Fed's quantitative easing. So let's expand on this since we're on the gold theme. And let me pull up the chart. Let's see what chart. Oh, yeah. Let's go. I'll let you watch with me here. Let's go back here. Again, because the power went out in the middle of the first record, I have to think back of where I was going to this. We're going to go back to this 3-month treasury yield and consumer. Oh, you know what? This isn't the chart I really wanted. Let's go. I thought it was. But let's pull up a different chart here. I need 10-year treasury yields. That's what I need. So here's a chart of 10-year treasury yields and the unemployment rate. Inverted, so you can see when yields go down, unemployment rate is going to skyrocket. But that is not what we need to look at. We need to get rid of the unemployment rate. And we'll let the graph adjust. And now we're going to go back and we're going to add the consumer price index to this. And we're going to change this to the year-over-year percentage change, so that way it's a percent. And then we're going to add those two together. Because according to Steve's view of gold, okay, let's go look at Steve's playbook on gold. Gold playbook. When yields are going down and the CPI is going down, you don't want to own gold. Okay, that's my whatever, however I came up with it, that's my view. All right, and you need to see this. So let's go and add. So what we're looking at here, just real quick, is 10-year treasury yields plus consumer prices, so we can see them together. That's essentially, now we know. They're going up together, down together. That's what we need to see. So let's add gold. And we do not want percentage change from a year ago. And we want that on the right side of the graph. Now I'm going to tilt this into my favor real fast. Because it's my video, I'm allowed to do what I want, right? I believe the quantitative easing changed the game. So when people look at relationships, some people are like, well, you have to go back and look at 1913 when the market started and run them. Look, things were different then. We're on the dollar standard now. And now we have QE. So as far as I'm concerned, anything prior to QE doesn't really make a big difference to me. Let's go and look. So you can see that when this relationship is headed down, gold was flat. And when this headed up, gold headed up. But look, it dropped right there and then it took off. So let's zoom this in to a post GFC world. And now you can see they're pretty decently correlated. Not my wife is shaking her head saying, say relationship. Okay. The relationship is pretty decent. So you look here, when 10-year treasury constant maturity plus interest rate, so yields and CPI fell, gold fell. And when it bottomed, the gold market sniffed out that the two were going to go up, and there they did. So here we are right now. Yields are falling. The CPI is going to start falling because we saw how it's related to 3-month treasury yields and crude oil. That tells me gold comes down. That's what I think. All right, let's see. What is the average time / how long do you think deflationary period will transition to inflationary period? Normally, you get 3 years or more. It takes a while for it to move through the market. Assuming the Fed stops all further monetary policies, well, then the global economy is going to crash. And that would be the fastest way to deal with this. I don't have a time frame because the Fed's not going to do that. They're just going to crash it in other forms. But normally deflationary periods take a while to work through the system. I'd say 2+ years. Thanks for the response. You're welcome. I'm still trying to wrap my head around some things, okay? Let's see if we can help make sense. How can we measure the demand for dollars? Ooh, that's tough. My understanding is that most of the demand for dollars comes from the need for people to pay back dollar-denominated debt. This is correct. If this is correct, where can we see how much dollar debt exists? Look, I don't know. Raoul Pal, CEO and co-founder of Real Vision and the head of GMI, he says in a recent Twitter post, 13 trillion of dollar-denominated debt. The guy's real smart. I respect his research. I have no way to validate it or prove it otherwise, so I'm going to have to go with the fact that if he says there's 13 trillion, he's way better connected than I am, so I'm going to say that he's probably very close to the truth. I don't know if there's an exact way to measure it. So okay. And the second most demand for dollars comes from oil sales. I would agree with that being dollar denominated. I would totally agree with that. Are there advantages to buying bonds directly versus ETFs? Sure. So if you own a bond, you own the coupon. If you own an ETF, what happens is when interest rates are going down, the ETF, as bonds mature, will buy new bonds paying a lower yield. So if you're looking to hold a yield, let's say you go out and buy a corporate bond paying 5%. As long as you hold the bond to maturity and they don't default on the bond, you'll get your 5% and your money back when it matures. An ETF, there's no guarantee you'll get your money back, although highly unlikely it's going to go to zero. And your dividend yield will depend on the direction of interest rates. So it will go up if interest rates are rising, it will go down if interest rates are falling. Are all popular ETFs mostly the same? No. Are there better ones? That is a strong opinion. So there are a lot of different bond ETFs. There's treasuries, there's high yield, there's corporate, there's investment grade, probably that's under corporate. There are emerging markets. There's all kinds of stuff out there, and there are variations of each, so they're not all the same. So one company that has a high yield bond fund, there may be another company that has one, and they're not going to be identical. There's going to be some differences between them. How do you know which ones are good? I'm going to give you an answer you don't want. The answer depends on what your objective is. So the right one is the one that meets whatever you as an investor is looking for. Unfortunately, I can't give investment advice, and this would be very opinionated on me saying what I think is the best one, and I don't know. The question you're asking me is, hey, I want to drive from New York to Los Angeles. What car should I take? Well, I don't know. Are you trying to get there really fast? Are you trying to take a lot of people? I don't know. So again, depends on your objective. Do all bond term prices get affected the same way by quantitative easing? In my opinion, yes. For example, short-term versus long-term, 1 to 3, 3 to 7, 10-year, 20. Yes, they do. I believe so. The charts say so. Not everyone agrees with me. Last question. Hello. I've been watching your videos for about 2 weeks now, and I'm learning a great deal. Cool. I'm really glad to hear that. Welcome to the channel. The way the markets have been going, I decided to submit a question. Cool. Okay, as the Fed can only purchase debt, correct, and it appears that an enormous amount of money are hitting the markets. I'm a bit confused. Yeah, well, that's fair. That's why we're here. For example, on one of the recent Fridays, a coronavirus Friday, saw the S&P, SPY, the ETF of the S&P 500, same difference, rally up several dollars in the last few minutes. Does this appear to be government action? No. Or have channels been formed to send cash into equities? No. It seems with buybacks verboten, it shouldn't be corporations. No. So I'm left wondering what these huge odd movements are. So what's happening is the market is very volatile right now. And there's two ways you can put in a normal trade. And I know some of you say, well, there's lots of ways you can do limit order. Okay, two basic ways to put a trade in is a market order, which is execute as quickly as possible, or what's called a mock or market on close. It says, look, I don't need to put it in right now. Just trade it at close. So what happens at some point, and I don't know when or where this data is published. If it is publicly available, I don't have it, or I don't even know where it's at. But at some point near the market close, this data gets published of how many orders are sitting out there for market close. And when you're in a very volatile market, it can cause prices to go up or down real quickly. Let me give you an example. Let's say we're at an auction and there's something that goes up for auction that's $100 and normal price is $150, and all of a sudden everybody in the room raises their flag and says, I want to bid. Every person in the room. Now, do you think the auctioneer is going to be like, all right, well, who wants 101 or 102? No, they're going to be like, wow, the whole room is bidding? How about 200? They're going to bid the prices up, make people pay more. Same with the other direction. So if all of a sudden it turns out there's millions of sell orders, it's going to make people eat those and take a bigger loss. That's all the market's doing, is just taking advantage of the situation. All right, now I promised to talk about the dollar, and I do. So here's the M2 money stock. This is going to add into why I think gold goes down. Now, I've got this chart over here. They changed the dollar thing in the Fed database for some reason. I don't know why. And I haven't quickly been able to look up the new one. So I'm just going to copy that one, paste it over here. And this goes back far enough to work for exactly what I need it to do, which is pre-great financial crisis. So for all the dollar bulls in the crowd and all of the gold bears in the crowd, look what happened when the Fed drove the money multiplier down through quantitative easing. It shot the dollar up. And look what's happening right here. They've started their quantitative easing program at a big scale, and this isn't updated quite yet for this next week, but you can see it's pushing the dollar higher. So I think that big surge in the dollar is what brings gold down, in addition to falling treasury yields and consumer prices, and then all of a sudden you get the next big gold bull market. I think that's what happens. Again, the video is going a little long today, mainly because there will not be a video on Friday due to the market being closed. We'll catch up on that Monday. So I thought I'd go a little bit longer than normal, get your questions answered, look at some charts, help you become a smarter investor. Let's take a look at some charts real quick to see if any of this stuff makes sense. The S&P 500 is closed right over resistance and trying to break through. And everybody wants this thing to get back up to the 2900s and close this gap in here. That's what investors want. As we looked at, the bond market is not validating that. 10-year treasury yields, no matter how hard the market tries, they're just not getting it going anywhere. Even 30-year treasury yields are still struggling. And so let's take a look at TLT. And it had some nice price action today. Let's zoom in. What happened is it had a nice day going forward, and then toward the end of the trading, it pushed higher and came right back over what is now looking like a support line. We can see in after hours trading is a little down, but that doesn't necessarily mean anything at this phase of the game. So what you have over the last 30 days is what very clearly looks like a bottoming pattern. You cannot say this is a topping pattern because it looks opposite of a topping pattern. You would see this spike up here. You wouldn't see this shape that we're seeing now. So right now, resistance or support is sitting right where prices are at. Again, this is 1.2% up here. I think we break this and then you're off to the races, and that pulls the rug out of the stock market. But you have to understand, stock investors need bond prices to go down. They are shorting, and shorting some more because they have no choice. Let's take a look at the dollar. And here we have the dollar came down, hit support, rallied up through resistance, and is now retested overhead resistance, which suggests now to me the dollar makes another run at 103, breaks through 103, and the wheels will come flying off the bus on this deal. So let's wrap up, and appreciate you taking the time to watch it. I will be back Monday. I assume we'll have all the normal credit data, and we'll play catch up on Monday and then get back into our normal swing of things. Thanks for taking the time to watch. Thanks for submitting your questions. Hope the video is helpful. Hope you learned a lot, and I hope you have a great Easter. I'll see you on Monday. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. This channel is not to be construed as a recommendation or solicitation to buy or sell a security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in the video that are known do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.